Welcome, everybody, to the Latham & Watkins Forum. As you are coming into the Zoom room and settling in, let me first go through the protocols for CLE credit today. During this forum, you will see and or hear one or more CLE code or codes. You will enter the code or codes into the attorney affirmation form sent to you after the event. If you do not include the code or codes, you will not be awarded New York CLE credit. So thank you all and welcome. When we were interviewing Michael Ohlrogge to join the faculty, he was telling us about his research on SPACs. And I remember saying to him and to his co-author, Michael Klausner, I said, what's this about? We've had blank check companies for years. That's not a good topic for you to work on. And of course, I was wrong. It was a great topic. Michael's first article now has something like 26,000 downloads from SSRN, which is probably more downloads than all of my articles put together. So as always, I am pleased to have learned something, even though I was utterly and totally wrong. And it's this SPAC craze that we're going to talk about today. They've been the hottest thing on Wall Street. They're supposedly a new, better way to take companies public. They've become the hottest new thing with celebrities entering into the game. And the question is really what's going on here? We have a wonderful set of panelists for today. We've got Scott Kupor, the managing partner at Andreessen Horowitz from the Valley. We've got Michael Ohlrogge. We have Rachel Sheraton, a partner at Latham & Watkins, who focuses on capital market transactions. And we have Andrew Ross Sorkin from the New York Times, from Squawk Box, CNBC, from the TV show Billions, which many of you undoubtedly have watched. And we're going to try to dig down here on what's going on with this SPAC phenomenon. Where did it come from? How does it change the capital markets? Where is it going? This webinar is in the Zoom webinar format, which means that participants, if they want to ask questions, should put their questions in the Q&A box, and I will do my best to weave the questions into the discussion. Let me start with Andrew. Andrew, you've been writing about SPACs. You've been following it. Blank check companies, as I mentioned, have been around for decades without it being a thing. Where did the SPAC phenomenon come from? What's the human backstory? Who are these people who developed this line of business, and what were they doing before they got into SPACs?
Well, I think that SPACs have obviously been around for a very, very long time, and clearly there was a market, but it was a small part of the market. It was always a bit in the shadows. It was always considered, I don't want to use the word shady, but it was considered a backdoor way to go public. And the very phrase backdoor, I think, speaks volumes about how those types of transactions were perceived. And I think a couple of years ago, probably with the helping of Chamath Palihapitiya, who created sort of branding around the idea of an IPO 2.0, sort of a new structure, a better way to get public. You saw a number of folks that had either been in Silicon Valley, venture capitalists, private equity folks, I want to say bigger name people decide they wanted to get into the sponsor business. And of course, the economics of being a sponsor are tremendous, or at least thus far have been tremendous, given that you get about 20% of the vehicle as yours as compensation. I call it, it's not pay for performance, I call it pay before performance, because you get it on day one. And so that's really, I think, what sort of set this off. And I think there were a handful of successful SPACs that took place over the past couple of years, and that in turn led others, whether they be chairman of other companies or people, retirees who used to be CEOs, decide I'm getting into this business and I can use my brand, my personal brand, as the quote unquote sponsor to back these new, younger companies.
And the figures who are doing this, right? So let's take the first wave of the SPACs. Somebody got this idea, right? And so it was around. Did somebody just wake up in the morning and say, let's do a SPAC? How did these blank check companies, which, as you say, had this really kind of sketchy reputation, and they go back 50 years. You know, Matt Mallow, recently retired vice chairman of BlackRock, told me that when he was an associate, he worked on a blank check transaction. So they've been around for a long time. But what is there? Can you put your finger on anything that kind of sparked this revival, other than somebody having an idea one day that maybe this would be a good idea?
I don't know if it's hard to know. I'm sure I wonder if others, whether Scott or Rachel or Michael or others can pinpoint the moment. I don't know. I mean, look, I think it's also, there's become obviously a lot more liquidity in the market. I also think the structure of the market, there were so many questions about whether the public market even worked at all. So I think, and whether companies wanted to become public, whether the IPO process worked, whether companies, there was research around them, analysts and the like. So I think there was a whole sort of move afoot to try to get investors and public investors, retail investors, earlier access. I think that was at least thematically what people told themselves.
I think, if I could, so I would agree with that, Andrew. I do think there is this bigger picture question of, fewer numbers of IPOs, companies staying private longer, and therefore obviously a push towards getting them earlier. I think the other thing, and Michael, I think your research highlights this a lot, is just the interest rate environment and kind of what that means for hedge funds who are sitting on very, very low interest rate environments with effectively very attractive economics sitting in the kind of SPAC to de-SPAC transaction, right? In other words, Michael, again, I think if I'm quoting your research correctly, something like, 11%, kind of annualized returns on average for a lot of these early SPACs for basically what is effectively a risk-free asset that people are buying. And so I wonder if, again, just the confluence of obviously all the market interruptions that we saw last year in the wake of, COVID, coupled with a historically low interest rate environment, just kind of encouraged people to look for other ways to find yielding assets. And that may have been part of it.
Do you have a sort of a pinpoint spot in terms of the human backstory? Like, when did SPACs first come across your desk?
Andrew mentioned Chamath Palihapitiya, and I do think in terms of kind of people who popularized this and made it, put a human face on it, I would say he was probably the most important character in this story. Look, Chamath has been a very long time investor in the Valley. He's done a number of things. He had a venture firm. He spent obviously a bunch of time at Facebook and then had a venture firm. And that venture firm kind of, also morphed into more of a public equity vehicle. But I do think in terms of, somebody who has kind of been a cheerleader for it. In fact, I don't know if he dubbed himself this or Andrew, the media did, but he has been dubbed the king of SPACs. I do think he was somebody who, look, he has a big megaphone, and he certainly and I think to Andrew's point, he positioned this, as an opportunity for companies to be able to get public earlier and therefore deal with some of this bigger existential question that we have around where do traditional retail investors have an opportunity to participate in appreciation of high growth companies? And I think that was a big part of the narrative.
Rachel, when did you first hear about SPACs?
Yeah, so the first significant SPAC transaction I worked on was Clarivate transaction, which was probably the first. It preceded Virgin Galactic. It was a over $4 billion valuation company, and it was owned by private equity sponsor Onyx. And they met up with Michael Klein, who was contemplating a SPAC at the time, with a very informed co-sponsor, Jerry Steed, who was running at the time a business that was competitive with Clarivate and was really an industry expert. I think it's a very good paradigm example of how the SPAC process can work incredibly well. Heretofore it had not worked, I think, really well, but in the Clarivate example, Onyx was looking for an exit. You know, they obviously had at its disposal IPOs. Lots of sponsors have been doing IPO exits for many years. They had an M&A transaction as a possible exit. And then they had this possible SPAC transaction with you know, an industry leader and Michael Klein, who obviously understood the economics and the value of a SPAC from his perspective. And so that, I think, was the very first, and this was right before Virgin Galactic. I think that was the very first SPAC transaction I had worked on. We heretofore, most of my career was not spent representing SPACs or anywhere close to that. And now I feel like I have about 30 SPAC transactions on my plate at any given time. And so that was the first sea change. I think that if you look at that and examine that transaction was very successful. It was a very long lockup period, Andrew, to some of your earlier points that had alignment of sponsor interest as well as the financial private equity sponsor. There was a slow sell down, very accretive, and there was an industry expert that, you know, the head of the SPAC actually became the head of the business. And so in that, you can see a lot of value as to what Onyx got out of that, and to what the shareholders ultimately got out of that transaction, and continues to be a very successful public company. And then you follow on the heels of that Virgin Galactic, and then, you know, the story and the marketing around SPACs really picked up pace. But I think Clarivate gave it a lot of credibility in terms of a viable, substantive alternative, and I think really raised the profile of SPACs as not something that was in the shadows. Historically, I agree, they completely had been. So that was really a turning point for me and for, I think, Latham's involvement in particular, representing targets as you know, looking at exit alternatives. That became a viable alternative, and now, you know, an incredibly popular one at the moment. We'll see about the sustainability of that.
Michael, how did you and Mike Klausner come to start working on SPACs?
Yeah, so it was kind of interesting. We first started looking at them because of the warrants that were built into them, and they seemed very odd to us. And our first sort of question about the warrants, so when a SPAC conducts its IPO, it sells units, and they contain shares and warrants, and the warrants give the holders an option in stock of the company that the SPAC takes public. And this seemed odd to us, although at that time we had no idea how odd, but it seemed like it could create a situation where you could have a merger that would be good overall, but that might get rejected by the investors in the SPAC because of these warrants creating an overhang and taking down the upside of the company, but leaving investors with just the downside. And it just seemed very odd to us.
We'll get to that, but
yeah.
How is it that, well, I didn't think to write about SPACs. How is it that you guys thought to write about them? Where did the sort of the germ of the idea come? Was it a deal that you saw, as Rachel points out, that brings it to your attention? Was it somebody you talked to? Where did the idea for the article come from?
Yeah, well, so some of it came, Mike Klausner has a deals class that he runs at Stanford Law. And I'll also say, Mike isn't here on the panel or in the event today, but Emily Ruan, my other co-author on the project, is. So I want to give a shout out to her. So, you know, he had a SPAC deal, I actually don't recall which one, who presented in his class, and you know, the person there was the attorney representing the target. And that person just sort of started saying some things that didn't make a lot of sense. So, you know, the person started talking about the sponsors promote and said, oh, you know, the sponsor gets 20%, and it's just like, you know, the PE 2 and 20. And it was sort of like, well, wait a second, you know, in the PE firm, you know, the 2 and 20 is 2% of assets under management and 20% of performance, usually in excess of a benchmark. And, you know, in the SPAC, the sponsor gets just 20% of the whole darn thing. And, you know, and that was really just the tip of the iceberg, is that there were so many things that people were saying about SPACs and just sort of saying them as if, oh, this is just the way it works. This is the accepted wisdom. Everybody understands. This is, you know, what sophisticated market people do. And so much of it just made no sense whatsoever when you started thinking about it.
So for those of you who don't know Mike Klausner, one of Mike Klausner's great strengths as a scholar is, first, he's really smart. And secondly, when he doesn't understand something, he's not embarrassed to ask. He's not embarrassed to say, that makes no sense to me. Let's tell me why it works. And he keeps hounding people when things don't make sense and eventually gets to understand it. So Michael, SPACs are presented as this great alternative to IPOs and maybe to private placements. What did you find? Are SPACs a good deal for SPAC investors, for the firms that merge with SPACs, for the shareholders of the firms that merge with SPACs, for SPAC sponsors? Who are the winners in this?
So it really depends because there's so many different groups involved in SPACs. So as Scott pointed out already, people who buy into SPAC IPOs have gotten a great deal. I mean, they spend $10, they get a unit, which is a share, and then some number or some fractional number of warrants in the post-merger company. They have an absolute right to redeem their share, get back all of their money plus interest, and then keep the warrant for free. So it's impossible to lose money on that transaction. It's just an amazing deal. People make great returns. It's not hard to see why people are pouring in to invest in SPAC IPOs. What's a little harder to see is why that makes sense to be handing out all of this free value. But people who buy into the SPAC IPO, and basically my research shows almost 100% of them are going to exit prior to the merger, either through redemption or through sale. They do really well. So they do well. Target companies also do well. In general, what I find is that the SPAC transaction is very expensive, but target companies understand that, and they're able to negotiate merger agreements that protect themselves pretty well. So one of the challenges with a SPAC is that it's giving out free securities left and right. It's giving out, all these securities to the sponsor. It's giving out free warrants to the IPO investors. It's paying huge fees, much higher to banks, much higher than would be in a typical IPO. And so in a lot of SPACs, by the time it gets to a merger, it'll maybe have $7 of cash for every share that it has outstanding. But if you've got a good target that's represented by sophisticated counsel and good financial advisors, they understand that. And I've talked to lots of them. And as long as they feel comfortable, they're saying, hey, I'm getting shares, I'm getting $7 per share. I'm gonna negotiate a merger agreement that gives you shares that I think are worth about $7. And as long as they can pull that off, it's a good deal for them. Now, it tends not to be as good of a deal for the SPAC investors, because if they're passing up a redemption right for $10 and getting a share worth $7, that doesn't work out so well. And at least on average, but there's a huge amount of variation, on average, the investors who hold through the mergers have not done well. And every single year for the past decade, including 2020, as of a year post-merger, SPACs on average have underperformed against market indices. Our contention is it's not an accident, it's due to these high costs. But there's a huge amount of variation. Some SPACs have much lower costs than others. They tend to do much better. Some SPACs have sponsors who can really add a lot of value to a transaction and can make that SPAC worth more than just the cash that it has in its trust. And in those kinds of situations, the investors can do well too.
Scott, you've got lots of portfolio companies, and historically some of those you've exited through sales to strategic buyers, and others you've taken public. And now apparently SPACs are an alternative way of going public, as are direct listings, as are traditional IPOs. How are you thinking about SPACs as part of this set of options for going public?
Yeah, at a very high level, the idea that there is choice and there is competition in the market is a good thing. So right up until really a couple of years ago, the traditional IPO was really the only route that was possible for most of these companies. And then certainly, obviously it's not the topic for today, but direct listings, of course, have become a much more viable option, even though there's still a relatively small number that have chosen that path. And in some respects, SPACs are, think of them then as a third option, which, to Michael's point, look, there are things that may be attractive to SPACs, which is, maybe you have a sponsor that truly can bring some, needed market expertise, or maybe you have the ability to bring in a set of pipe investors, for example, that gives you, a significant amount of capital to be able to achieve what you're trying to achieve. So I do think the idea of having multiple avenues is a good one. Obviously, and I've said this publicly, I mean, I agree with Michael that I think there are lots of things left that are, need to be addressed in the SPAC market, particularly dealing with some of the things that Michael has talked about. I mean, the idea of the, sponsor promotes and people understanding who's actually getting what, I think is still incredibly opaque, particularly for, for example, for a retail investor who is buying in the aftermarket and holding through the de-SPAC process. But I think the idea of, at least the concept of companies being able to go to bankers or their boards and say, look, we have potentially 3 viable options to think about going public. Look, I think from a market perspective, that's actually a very positive thing. That's not to say, obviously, that there aren't things that need to be improved on it, but I think that presence of competition is an important aspect of the market.
But take us into the thought process. So you have a company
Yep.
that is at the stage where it's appropriate to go public. And you've got, I'm sure you get calls every day from 20 or 30 SPAC sponsors who are looking to do a deal. First question is, among the SPAC sponsors, what are you looking for? Are you looking simply at what they're willing to, the valuation for the company? Are you looking at what they're going to bring to the table in terms of their management ability? You're looking at your bargaining leverage, because of course a SPAC, as it approaches the time when it has to send back money to its shareholder, to its investors and dissolve, is going to be particularly interested in doing a deal and may give you the best valuations. How are you thinking about, of the 20 people who are on the phone to you every day saying, I have a SPAC, I want to buy I want to merge with one of your companies? How are you doing that selection?
Yeah, so Ed, it's really, so first of all, it's, look, all the things you mentioned are part of the calculus, but ultimately the way we think about it is it's a question of alternatives. So I'm working with a company right now in our portfolio where they're considering, a significant late stage private financing round, in contrast to, or I should say in competition with, a potential SPAC/PIPE opportunity. And the discussion at the board is exactly that. The discussion is, okay, like, which one do we think has greater certainty of close? Which one do we think has, better overall valuation prospects, long-term for the existing and future shareholders? Which one do we think has, either a sponsor or a set of shareholders that are long-term oriented who might actually be valuable, both from a capital perspective as well as a strategic perspective? And then look, ultimately, of course, at the board, we do have to consider the financial trade-offs. And I think the big, I'll just, just to kind of, highlight one big issue that's happening right now, and I know Andrew's covered this on CNBC, is I think what's happening right now is you have to distinguish between the SPAC IPO market and the PIPE market. And effectively what's happened right now is the PIPE market has become extremely challenging. So you will see, and we've already seen this, there are a number of companies who have signed up to do a de-SPAC where that is contingent upon a PIPE offering. And that market has substantially dried up. It's not impossible, but I would say it's very, very challenging. So that's a big consideration right now for certainly companies in our portfolio and anyone else's portfolio. Is it's one thing to negotiate a merger agreement. It's another thing then to actually get to the full de-SPAC process on the presumption that you can raise a meaningful PIPE. And so I think there's a material correction happening in the market right now. It will be a big lag, as Michael knows, on the SPAC side of things because of this 2-year time window that SPACs have. But unless the PIPE market materially improves, I think the prospect of significant de-SPACs in the near term is substantially diminished relative to what it was even 6 months ago.
So let me pause for a moment of translation for the
sorry
in the webinar, and just quickly go through what we're talking about here. So a SPAC, special purpose acquisition company. Did I translate that correctly? Is that the right?
Yeah.
A SPAC goes public without any operating company, goes to the market, and it raises money, on distinctive terms. It's for a term of 2 years. There is for people who invest in the IPO, they get warrants. The assignment for the person running the SPAC is to merge with a private company, typically, within those 2 years. If they do not merge within 2 years or have some other exit transaction, then they send the money back with interest to their investors. when they do invest, it has become typical that they do so along with what's known as a PIPE investment. PIPE is an acronym for private investment in public equity. And these PIPE transactions often bring along a great deal of additional capital, indeed, sometimes substantially more capital than comes from the SPAC. Because after all, at the time of the merger, even after the merger vote, the investors in the SPAC still have the option to redeem their shares, keep their warrants, and not participate in the merger. So the argument that Michael Ohlrogge made is that SPACs are good for the target, potentially good for the target company, because they understand how much money is coming in, both from the SPAC as well as from the PIPE, and are unconfused, undeterred by the amount of free equity through warrants that have been handed out. Michael also made the point that it's good for the investors in the IPO who get these warrants. Typically, they are institutional investors of a particular sort known as the SPAC mafia, a bunch of firms that have invested in SPACs over a period of time. They typically do not stick around for the merger, but instead sell or redeem. So what we're now talking about, and what Scott was taking us through, was from the point of view of a potential target, a private company. What's the set of considerations in whether you merge with a SPAC, which is known as a de-SPAC merger? Rachel, from your perspective, representing a bunch of companies who now are thinking through this set of alternative exit options into the public markets, how do you think about it? How do you weigh the pros and cons and make the decision with your clients as to which option to take?
Sure. So, I mean, I think we look at some of the same things. Obviously, the economics are not something we typically weigh in as lawyers, but we have views. We've done enough of these, so we do have some views on that. I think something you said earlier, Ed, is interesting. You said when a company is ready to go public, and then they, make this decision. The interesting fact is that a lot of these companies are not ready to go public, right? But there are so many SPACs out there pursuing a more limited set of targets that that is a consideration we take in, that we weigh pretty heavily from a legal perspective. Could this target be a public company in 2+ months or 3 months at the outset? And typically in an IPO world, we're working with a company, many months in advance of a potential launch of an IPO transaction. And there's a lot of processes and thought and hand wringing that happens. These SPAC transactions have come to play at a very quick time frame. And so what you're seeing is a lot of expedited legal background governance work happening on a pretty quick basis. But frankly, after you sign a merger agreement, there's then we now are going to become a public company shortly. So we do spend a fair amount of time talking about, can we do this? Are you able to be a public company? The accountants are incredibly involved. There's a lot of accounting issues that come up with these companies in terms of being able to report in a timely fashion. They typically don't have financial statements that are prepared in a PCAOB basis. So there's a whole accounting work stream that we have to work through. So timing becomes pretty critical. And then looking at the SPACs themselves, the processes emerge much like it did in the M&A context, where we have, any given target has multiple SPACs pursuing them. And I'm sure Scott has seen this too. And so the process has turned out to be much more like it would in an auction M&A process, where the SPAC, we really work with our target companies to dictate the terms that we want. We don't look for a specific valuation, frankly, from a SPAC sponsor, because that's not who validates the valuation, right? It's really the PIPE investor that validates the valuation. And so when we're considering who would be a very effective partner from a SPAC perspective, it is, as Scott mentioned, who has success in the pipe market, who has the credibility to get us a valuation that we think is in the range that we want, and can do that, in what is an increasingly difficult pipe market. There's been some fluctuation back and forth over the last 6 months in the pipe market, but is an incredibly tight place right now. The idea that you have flexibility around a secondary component, I think, is off the table at the moment. And so we talk to our clients about what is it you're trying to achieve in terms of, whether there's a secondary component necessary for founders. What are you trying to push? Are you trying to push a dual class structure? Is that something the market will accept at this juncture? So we really get pretty granular, Ed, with respect to what we're looking for from a SPAC sponsor. Then we put those terms out to those SPAC sponsors as a logistics matter, much like you would in an M&A auction process. And then we work through what we receive back in those terms. And then we occasionally, the value in many respects of a pipe process is that you can go out without being really public about it, talk about valuation, and come to determination before it's incredibly public for the private target. You don't have that same sort of price discovery necessarily in an IPO context, and so that's really the value that we see companies looking at with respect to SPACs right now. And that's kind of the process we walk through with them. It's often a tri-track process, right? It's IPO, it's SPAC, and it's M&A. We look at all three of those. Direct listings, as Scott mentioned, is an alternative, but I think for a very limited set of targets right now.
So let me drill down on some of these points.
Sure.
First, let's think about your analogy to the auction process in M&A.
Yeah.
If a company is being auctioned for cash in the M&A process, you don't actually care who's buying the company, except insofar as the deal will close and they'll produce the cash. Under Revlon, you're looking for the highest value reasonably available, and the shareholders are largely exiting. Here, the shareholders aren't exiting any more than they're exiting in an IPO. The shareholders are in. So you focus instead, from what you were saying, on what the partner is going to bring to the table. And a big part, it seems to me, there are two things that you focused on in your comments. One is the pipe, which is to say, how much money, how much financing are we going to get from investors? And the second is the potential value added by whoever is running the SPAC. So certainly part of the story, the marketing at least, of Bill Ackman's SPAC is that Bill Ackman is a really, really smart guy who can bring great value to a company that he gets involved with. And if you do your de-SPAC transaction with Bill Ackman's SPAC, then you get Bill Ackman. So the two pieces. Let's focus for a moment on the pipe piece. You can do a pipe in connection with an IPO. You can do a pipe in connection with a direct listing. What is it about the SPAC craze where this pipe, at least in some accounts, is a feature of the SPAC rather than just a useful piece of the going public process?
So I'll answer the question and then maybe what others have to say. I think that it is a much more well-worn path in the SPAC context, right? So there is a market for it and people understand the cadence of the process and they're willing, and sponsors know, SPAC sponsors know how to access the fidelities and present a story and get a deal done. A concurrent private placement in the context of a direct listing, that's a different story, right? Yes, there is under the NYC, I think, the ability to now do, 30 days prior concurrent private placement, but raising primary funds in the context of a direct listing is a less certain approach. And I haven't seen anyone successfully yet navigate that. I do think TBD. In the context of an IPO, yes, you can do a concurrent private placement in the context of an IPO. And I think this is where you will ultimately see convergence amongst all of these processes. So if you look, for example, at the Endeavor IPO that was recently placed, that's a great example of where they're pulling some of the value of getting valuation up front. Fidelity was on the cover at a specific price on the Endeavor IPO based on their concurrent private placement. in some respects acting in the same way evaluation does from a PIPE perspective in the SPAC. So you're right, you can do those same things in the context potentially in a direct listing eventually. Yes, you can do it in an IPO, but the PIPE in the context of a SPAC is a very well-worn path, right? And so there's a market for it, there's a process, and there's a cadence to it that people have, and obviously over the last 6 to 12 months has become even more of a certainty that you'll either get an answer one way or the other. And I'd say in the other context, it's a little less clear and a little more bespoke in trying to navigate that. But I defer to others a bit.
Yeah, I agree with what Rachel said. I would also add, look, we have a concept of this already in the non-SPAC markets, which is a number of companies, for example, that have done direct listings, have done private placements, with traditional, what I would call kind of crossover investors that often predate by only a couple months often the direct listing process. And part of that is to, sometimes those are liquidity opportunities for employees, but oftentimes they are an opportunity to get a public shareholder into the private capital base before the direct listing, so that you have the support of those institutional investors. And then you do see this sometimes also in the traditional IPO market. But I would agree with Rachel. The PIPE market is more robust, or at least it has been more robust in the SPAC market relative to these kind of, semi-concurrent, private placements followed by either direct listing or traditional IPO.
To follow up on that, a lot of times people ask me, are SPACs all about, regulatory arbitrage? And I argue that most of the regulation differences are small. I almost think of them more as a cultural arbitrage more than anything. And, touching on what Rachel and Scott are saying is just that there's practices that SPACs use that could be used in other places, but it's just not the way it's done, which I think is fascinating in and of itself. Although I think it's odd that so far we're at the spot where we're spending a lot of money to compensating people in the SPACs process to overcome these cultural barriers, and it's exciting though to see over time them coming down and hopefully making the process more efficient along multiple of these paths public.
But I think there's one major distinction though, which is that even though the PIPE is acting as the sort of credentializer for the valuation, most SPACs really are relying on heavy retail investors. So there is this sort of retail audience that is, and it's a much larger retail audience on a relative basis. You can go look at some of the stats in terms of who's actually in these stocks. And then the second part, which I'm sure we'll get to at some point, is that these are companies that rely on projections and forecasts, which is something that has really never been a feature of the classic IPO market for legal reasons in terms of liability. And I think that plays a huge role in the distinction between why you see some companies pursuing the SPAC route versus the more traditional direct listing or IPO path.
So we'll get to that, Andrew. But so your take is that ultimately, so what do you need in a public company? What you need in a public company is you need a secondary market. You need people trading, you need institutional investors trading, you need retail investors trading. And that, so on your account here, the PIPE is the bridge, the credibility bridge that takes you from the private market to a thriving public market. So it has both the value of putting more capital into the company that Rachel focused on, but it's the process of putting capital into the company that gives the company credibility now in the secondary trading market, because ultimately, whether you go public as an IPO, in a direct listing, or through a SPAC, the test is, do you have an active market for your shares 6 months, 12 months down the line? Is it your sense that the retail investors are right to view the PIPE as providing the kind of credibility, the kind of reputation enhancement that in the IPO context, historically, the view has been it's the investment banker, it's the underwriter who plays that credibility
I
role.
pray that the retail investor is smart enough to know that actually you desperately need to look at the PIPE. You should be looking a lot closer at the PIPE investment and the valuation and what work's been done there and whether you think they're credible actors or not, much more so than I would ever look at the sponsor, because the sponsor really does. I mean, it's interesting. You described the investment bank as a brand or a franchise or as a credibility piece of it. I no longer think that. I think that was maybe true a decade or 2 decades ago when it comes to a bank brand. I don't know how much of that plays a huge part into this anymore. To me, the sponsor is actually much closer to playing the role of an investment bank. And what I'm sure about, because we've actually done some very informal polls, but it's clear anecdotally, most retail investors have no idea that the sponsor doesn't really intend to stick around. That in most cases, they plan to sell their shares within about 12 months. In some cases, there are lockups that are shorter than that, to maybe 6 months, depending on how well the stock trades in the period after the offering.
So Andrew made the point, Rachel, and I want to turn back to you, that the one big difference he suggested between the SPAC and the traditional IPO is the ability to use projections as part of the marketing process, and that's not as easy to do, or that there's greater liability to do that if you do a traditional IPO. Do you agree with that?
I mean, he's correct. That's right. So, but just let's maybe worth spending 2 seconds as to why projections are acceptable in the context of a de-SPAC transaction. So the way that projections get into, the S4, the proxy statement, which is the document that governs, that shareholders see, is because the sponsor has to explain to its shareholders the basis for its recommendation for voting for this transaction. As part of that analysis, they have to explain the projections they reviewed. The side benefit, though, however, from a marketing perspective of those projections being available in that context is that for the first time, investors, are seeing the forward-looking projections of the company. Projections always exist at businesses. They obviously all have models. In an IPO context, that model is only given to analysts, and analysts see that information at investment banks and then digest that model and later produce their own version based on whatever issues and things they see and project out, their own model. But it is correct that in the IPO context, because of the liability regime established by the SEC a long, long time ago, people do not put projections into their IPO documents. There's a strict liability standard on those disclosures, and there's no way to know. And I, as a lawyer, would never recommend including projections under that standard because there's no way for you to be sure that those would be met. But the SPAC does have the benefit of marketing with these. And I'm a little torn, right? Because it is interesting, good information that's out there. It's out there in a context because that's what the board is considering and recommending it to the SPAC founding shareholders. It does give the market broader ideas about what this business intends to do. And it is interesting in the context of these businesses that we're taking. A lot of the targets we're working on are pre-revenue stage businesses. They don't have a ton of historic financials. Looking and focusing on the historic financials will not give you that great insight into how the business is going to run or what it's going to do going forward. So it is exactly right. Andrew is exactly right. That is the issue. The projections exist. But then there is no update of those projections once the SPAC business becomes public, for the same reasons why you don't include them in an IPO. So it is a little bit of an interesting disconnect, and it is helpful in some ways, and I think hurtful in others going forward. And if you unduly rely on those projections in as a retail investor buying post signing of the business combination agreement, you should have zero expectation that you'll ever get update on those projections. You're only going to get 34 Act required disclosures going forward. And so those, and to Andrew's point, do people really understand how long sponsors will stay in the business? I mean, it is disclosed, right? But it puts a fair amount of emphasis on people actually reading all of the detailed disclosure, which as retail investors may not always do. So that information is available to be digested, but it is certainly not highlighted in any way that you're going to see on the front page, although it is fairly clearly disclosed, but it's not hidden. You just have to know to read for it.
Right.
So,
Rachel?
Yeah.
And I don't want to move too far afield or forward in the conversation because we may get there. Do you believe that the SEC ultimately will create a stricter standard on liability when it comes to this? And do you think that if shareholders or the government were to ultimately bring suits against sponsors and effectively subpoena emails and other kind of correspondence and traffic about how they got to those valuations, that you would start to see not just the rosy projections, but much less rosier versions, and that therefore you would create remarkable liability for the sponsor.
It's all certainly possible. There's obviously lots of discussions. I myself do not prognosticate, and it's not always in my best interest of my clients to do that. We're currently situated, but I do think this is the exact area that the SEC should be focused on. And I will say, in the context of people circling around these de-SPAC transactions, right? The investment banks acting as placement agents. There's a lot of hands in the mix. People are becoming very focused on this, including sponsors who are now looking potentially at fairness opinions as being included, which historically has not been the case. So people understand that there's, blood in the water and there's a focusing. I don't know, the SEC would have to change the law, right? And they can't just impose that standard on its own. It would require a law change. So that's not going to happen overnight, but I think the SEC has made it very clear in recent pronouncements that this is a focus of theirs, and I think we should all, it'll be the Full Employment Act for lawyers. I'll just put it that way, because there's a lot of stuff that's going to be happening.
I would add. Oh, sorry,
Michael, and then to Scott.
Yeah.
Michael? What do you see as the principal regulatory differences between the SPAC versus the traditional IPO? And is it your sense that those regulatory differences are driving, in any sense, the choice of the SPAC? And then I'm going to ask Scott the same question.
Sure. So the projections are a meaningful difference, although I would caution against overstating how big the legal difference is. So even if a company goes public through an IPO and gives projections, it does have a defense in the event that the projections are wrong. It's not that they get sued just because they missed the projections. They have this judicial bespeaks caution doctrine, which is very similarly worded to the statutory protection that SPACs enjoy. But because the SPACs enjoy a statutory law, it's more uniform across the country. It's less subject to judicial interpretation and uncertainty. There's a little more comfort relying on it. If I had to guess, I would think, though, that if the SEC changed things and made it so there was the same legal standard for SPACs and IPOs on projections, my guess is SPACs would continue to use projections. I think in general, a lot of times it's a different team of bankers, different teams of lawyers who work on IPOs versus SPACs. Not always, there are plenty of people who do both, but there just seems to be a culture that people have become comfortable using these projections and disclosing them. I think they would continue to do so even if there weren't that regulatory difference. It's also harder to sue a company that has gone public through SPAC for misstatements or omissions in its disclosures. So a lot of people mistakenly think that there's different requirements, that you don't have to disclose as much in a SPAC transaction, or you can lie with impunity or anything like that. That's certainly not true. And the SEC still reviews your documentation in pretty much the same way. But if a private investor alleges a misstatement or an omission in those transactions, it's easier to sue in an IPO. It's harder to sue in a SPAC. And it's also, perhaps importantly, it's much easier to sue a bank in an IPO transaction, much harder to sue a bank in a SPAC. At the same time, though, it's important not to overstate that. Banks pretty much always get an indemnification clause when they do a traditional IPO. And so even if they're liable, the issuer is going to reimburse them. The only time that the bank is actually on the hook for money is if the issuer goes bankrupt, which sometimes happens, but it's pretty rare. So, there are some differences, but in terms of, the actual economic reality of those legal differences producing, it can be smaller than it might seem at first glance.
Yeah,
Scott, I need to announce a CLE code for those of you who are getting CLE credit. The code is SPAC Craze 101. SPAC Craze 101. Scott, are the regulatory differences between IPOs and SPACs a big deal in terms of the choice of how to go public?
So I think the market is telling us they are, in the sense that what I think those forward projections in the SPAC market have enabled is companies that are otherwise at an earlier stage of development to be able to go public via the SPAC process. And that's why I think you see a lot of these frontier technologies. We've made it almost an hour into this discussion without bringing up Lordstown, so I will just for the record, I will throw it in there. But I think it's not an accident that you see these kind of more frontier type companies in the SPAC market, because I do think that the ability to put a 5-year forward forecast out there for companies that are today either pre-revenue or very minimal revenue, and to help investors understand what the potential could be, makes a difference. I would also add, just to Andrew's, I'll answer Andrew's question, or at least offer a perspective on the government. I had the chance to testify at the House Financial Services Committee a couple weeks ago. What was striking to me in that conversation was there is fairly strong bipartisan support. Now, of course, that may or may not actually result in anything, but there is fairly strong bipartisan support that this idea of having a level playing field between a traditional IPO and a SPAC ought to be what happens, and whether the SEC can do that. I don't know if they can do that through rulemaking, or that requires Congress to do something, but I think there's no question that there will be regulatory pressure applied to the SEC via Congress also to try to address what at least is perceived to be, maybe incorrectly, but is perceived to be a loophole from a regulatory perspective that makes, the SPAC process. The last thing I would just add,
let me just jump on that for a second.
Yeah.
In that, if there is harmonization,
yeah,
your perspective is the right direction to go, increasing the either liability risk on SPACs or limiting the disclosure. That is to say, should SPACs become more like IPOs in terms of the legal regulation, or should IPOs become more like SPACs by freeing up IPOs to include more projections?
Yeah, I'm very torn on this one, to be completely honest. I like the idea. I'm a general believer of more information in the market is better, and so I would probably, if you put a gun to my head and maybe pick today, I would like the idea of harmonization that errs on the side of more disclosure, and therefore might make it easier to do these projections. What I worry about, and I think Andrew highlighted this, is we haven't seen this before. And so I'll tell you, in my business, in the private world, I see projections all the time. My business, I know they aren't worth, the paper they're written on, right? Because, I'm investing in early stage companies that are projecting in 5 years, they're going to have hundreds of millions of dollars. And I know that there will be no resemblance between that forecast that they showed me and what will actually happen in the company. What I worry, and I think Andrew maybe highlighted this on the retail side, is nobody understands that in the public company context. I think people believe that these are, kind of from the mouth of God, right, has come now these forward projections, and therefore they are written in stone tablets. And so somehow either we have to change the regulatory regime to make people be more conservative in those things, so that therefore they are more predictable, or we have to figure out somehow to help people understand that, what is the appropriate discounting you need to do against those projections. And look, that's a hard thing to do, just, with a broad swath of retail investors. I mean, I think that is legitimately a difficult task. And
I'll piggyback on that, is that the retail is obviously a concern, but I think other investors can get fooled too. So I have a follow-up project looking at SPAC projections. I look at all the projections in SPAC mergers for the past 7 years. And what I find is that even external stock analysts are much more wrong. They much more overestimate the performance of companies that have gone public through SPACs than they have for companies that go public through traditional IPOs. The more aggressive the projections of the SPAC, the more the external analysts get things wrong. Also, the more expensive the SPAC is, the more aggressive its projections are and the more wrong its projections are. So at a very minimum, I think there's a lot of learning that is yet to be done. Also, the larger the market mispricing errors in terms of the difference between the return as of 1 week versus 1 year post-merger. So there's a lot of learning all around to be done at a minimum around these projections.
Andrew, what are you seeing on the politics around this?
Look, I've spent a lot of time interviewing and talking to folks like Gary Gensler at the SEC. I think there is real interest in trying to come up with some solutions. I also think there's going to be some real interest in trying to come up with some version of enforcement. So I would not be surprised if the SEC were to bring a case against one of or more of the more outspoken sponsors, depending on what kind of evidence they amass. These wouldn't necessarily be criminal cases, but may very well be civil cases that the SEC would bring around projections and the like, and some of the documentation. But I do think that there is going to be a serious push over the long term around the projections issue, around the warrants issue, around the disclosure around sponsors and how long that they anticipate and plan to stay. And I will say this is my own view. I actually think that the sponsors have done a tremendous disservice to themselves, to the industry, and to the SPAC movement by not moving voluntarily on their own to make these disclosures and documents clearer. I think that even if you are an expert in this field, it takes a lot of work to go through those filings and actually even begin to understand what's really happening. And I, by the way, lay blame at the feet of lawyers who are involved in this. And I find it shocking, I find it distressing and upsetting that sponsors who have made the case that they are there to democratize the market have done such a disservice by effectively, and I'm not saying defrauding, but close to, as close as you can come to defrauding the retail investor about what's actually happening.
And by what's actually happening, let me get you to elaborate. The failures are things like not making it clear what the warrants are costing the company.
I mean, if
not
you
making
see, if
it clear how much
any
the
retail
sponsors
investor,
pay
let
out.
alone a professional, you could spend hours, I mean, hours trying to actually value the warrants, trying to figure out when the sponsor can actually leave or not, and what the formula is. And I mean, you can go through all of it. There's so many component parts that if I were what I think of as an honorable sponsor, I would create my own document with a front or second page that looks a little bit different, that literally spells it out in bold and says, this is what it is, this is what it is, and this is what it is. And instead, they follow the formula, and I understand that that's what they're doing, but it is buried, and I would argue purposely so.
Let's turn to the question of moving forward from here, right? So SPACs emerge in a kind of big bang. They're varying qualities. Problems emerge. Michael, part of what makes Michael Ohlrogge and Michael Klausner's paper so interesting is they actually go to the trouble of figuring out all these questions of what SPACs are costing investors, what the sponsors are getting. Moving forward, how should SPACs be improved so that they become a reliable channel among other channels for going public, and become a persistent feature of the capital markets, rather than if they become identified with fraud, the SEC will put them out of business or the market will put them out of business. So Andrew, if you had sort of 3 changes to make, in addition to your new second page that lays out everything, structurally, how would you change?
First of all, I actually think the disclosure can go a long way. I actually do think that disclosure can go a very long way. And I'm not somebody who is a believer that the SPAC shouldn't exist. I actually think they could become an important and unique feature of the market. I actually think could be great if done properly. I think that we have to deal with some of the misalignments of incentives between the sponsors and the de-SPACed investor class, if you will. I have a particular view, which I've written about in the New York Times, which is that if a company wants to make a projection and wants to make a 3-year projection, great. The sponsor should be locked into that investment for the duration of the projection. If the company wants to make a 6-month projection, great. The sponsor can leave after 6 months. But to the extent that we're going to have sponsors who are going to use the media, and you can blame people like myself and others who are going to go on television and whatnot and promote these things and promote them using the projections, it seems to me you should be locked into staying. Now, I know on the other side, people say, well, that's not really how it works, in an IPO. And it's a very different situation. And I get that, but I think that these are different instruments.
Rachel, what are you seeing as emerging best practices? Are there SPACs out there that are sort of the gold standard for what this asset class or this structure should look like?
So Yes, I think that, hopefully we work with some of those clients. Look, I agree with Andrew on one front. I do think disclosure is the answer. We have a disclosure regime. That is what we established. We did not establish a merit-based regime in 1933. We established a disclosure regime. And to the extent that the disclosure is not consistent or accurate or sufficient, I think that's worth fixing. And in particular, I would highlight, we spend a lot of time talking about why the SPAC came to the transaction, right? They're required the background disclosure around why the SPAC came here, what the SPAC considered. What we don't consider, right, which might be very helpful, is why the target came to the transaction. And that's an area of interest that I would think worth exploring, right? Targets, as you mentioned, Andrew, this and lots of other people on the panel, this is often a very good deal for targets. Sometimes better than other deals they've looked at. And if you were required as a target to explain all of the transactions that you considered, that would definitely lay out a broader set of facts for the investing retail public. So that's one area of expertise. I don't see anyone doing that yet, but I do see, glimmers of that in terms of SPACs seeking fairness opinions. Whether that's really sufficient or worth the time and effort, I don't know. But you do see SPACs pushing towards that. You see parties around SPAC transactions pushing for additional diligence and more level of certainty than they have before. All of those things I think are the right approach.
Rachel,
in terms of, oh, go ahead.
I was just going to ask, what would you think about changing the fiduciary duty, if you will, of the boards of the sponsor, so that they are obligated not just to the current shareholders, if you will, but to the de-SPACed group as well? It complicates things, but yeah, that may ultimately be the answer.
That's an interesting proposal and it's very nuanced, but I do think the disclosure I was describing kind of goes in that direction, right? Why is the target board, right? What did they consider in moving towards the same transaction? That kind of gets you in large part to a full disclosure of the impetus for the transaction, which I think would be helpful.
About a feature of SPACs that I find one of the most mysterious, which is that after the merger vote, you can still redeem, right? You can vote in favor of the de-SPAC merger, but then not go along with it, and then redeem and get your money back and keep your warrants. That strikes me as what we called in another context, empty voting. That in voting in favor of the merger, where the alternative, for instance, might be the unwinding of the SPAC and you lose your warrants, you're allowed to vote. How about limiting that? How about saying that and you can do this by contract, you don't need any legal change. No. How about saying that that if you vote in favor of the merger, you have to then accept the merger consideration and go forward with it?
Yeah, I mean, that's a fundamental, interesting aspect of SPACs, right? Which is, I think, for why they were kind of in the back shadows for a very long time. And that's not a secret about them, but I think to Andrew's point, it's probably not as well recognized that nobody votes down these deals. They all get voted for. The difference is it is full redemptions. I think it has to do with the nature of the people who buy, right? And never have an intention of holding in the long-term target, but they're buying. And Scott could probably comment on why people buy SPAC IPOs more than I could, but it's a different constituency, right?
Look, I agree with you. And I agree with both of you. Look, and I agree, Ed, it's a really interesting idea. I think, look, the other thing is the separability of the warrant from from that share as well, which is, to your point, not only do you get to vote for it, but even if you vote it down, you get to keep your warrant, right? And so I agree. Look, at a very high level, I agree with everything that, quite frankly, Andrew and Rachel have said, which is, look, to me, we have to have harmonization of the disclosure rules and we have to have some teeth behind them. And I don't know if this would make a difference, but look, maybe we should consider, underwriter liability for the investment banks who are part of the de-SPAC process, for example. It may not, I agree with, look, they're unlikely to get sued. They'll probably have indemnification, but these things sharpen the mind, right? If you know at least that there is a legal regime, maybe it makes people think about it.
But what do you think about as emerging best practices? What are the, if you were to point to a SPAC, what's the gold standard?
Well,
is it the Pershing Square tontine? Is it something else? What's the gold standard?
Well, so actually that's a great segue, because let me make the I don't want to make Andrew's head explode, but let me make the optimistic argument for why this is all good, which is what's happening here is exactly what you'd expect to have in what is today a relatively new market. I realize SPACs have been around.
I agree with you, Scott. I agree with you.
So it's exactly right, which is, look, so yes, there are people who are going to take advantage of a new system. That's always going to happen. There are a bunch of these companies are going to crash and burn. We're going to have more Lordstowns, right? This is not the end of it. And what I would argue, at least in a positive way, is in some respects, the market is addressing this, which is the fact that the pipe market is freezing up is a direct reflection of the fact that many of these transactions are not working. The fact that you have Tontine or you have other more, I wouldn't call them yet great, but I would say better in the sense of fairer sponsor economics, a little bit less warrant coverage, to Andrew's point, lockups that might extend these periods of time. So I would say on the positive side, the market is reacting to it. I still think, and I find myself in a very unusual spot saying this because I'm not much of a government regulation person generally, but I do think that we do have to address the disclosure regime. But again, I think if you take a 50,000 foot view here, one could argue, look, this is exactly what you'd expect in an emerging market, and the market will correct it. And if we have proper disclosure coupled with financial market participants addressing it, then I agree with Andrew. Look, maybe SPACs can be a real enduring part of the long-term market.
Michael,
So one of the things I like in terms of best
going and where things should go.
Yeah, so one of the things I like in terms of best practices is situations where you have a really, really big pipe and a really small SPAC, at least relative to it. That's where you can actually start getting more competitive cost structures with a SPAC versus something like an IPO or a direct listing. So one deal that I like is the altimeter grab deal. You've got a pipe deal that's 8 times the size of the SPAC IPO. And when you have that, the sponsor promote gets pretty darn small, the warrants get pretty darn small, the initial underwriting gets pretty darn small. And I mean, in my paper, I propose a sponsored IPO where it just says, because all the money raising happens at the de-SPACs phase, just don't raise any of it until then. If people aren't ready to go there, just do a really small SPAC IPO, do 25 million or 50 million, whatever's the bare minimum to get that thing off the ground, and then recognize that all of the action is going to be in the pipe. That can actually get the costs a lot better aligned. And there are some SPAC sponsors who see it that way. I was talking to one a couple of days ago who was saying, people should view a SPAC as the whole only reason is to get the pipe going, and that's all that it should be about. And if you can do that, I think that's a really positive thing. Leveling the regulatory playing field, of course, is another crucial thing. And as with everyone else, I could see it going in either direction. I do think that Scott's point about maybe we should have these projections and IPOs, it's something really worth thinking about, especially given some of this research that I am doing that shows that the better the SPAC, the lower cost the SPAC, the more accurate the projections. Makes me a little bit hopeful that maybe you could have them working moderately well in an IPO setting, but it's hard to say.
So I mean, let me follow up on that. So we're in a situation where there's lots of market activity. The SEC has not yet weighed in, but the SEC presumably could find a hook. And one way to use the hook might be to say SPACs will be illegal unless they comply with the following characteristics in the nature of a safe harbor. Most of those characteristics, the question is, what should those characteristics look like? If the SEC were to jump in and say a SPAC is illegal unless it complies with XYZ, presumably the market could preempt the SEC and adopt XYZ in advance. But what should XYZ be? Anybody have a view? Michael,
I'll take a quick stab at least. Look, I think I would separate out what is the role of the regulator and what's the role of the market. Look, I think Michael makes a really good point. I think the market has been very clear now on what is acceptable in terms of pipes and valuations and things of that sort, and even on the magnitude of sponsor promotes. And look, competition is a wonderful thing. As we know, there's Michael, like 400 SPACs out there that have yet to find a target. They've all got a ticking time bomb on them. Like, if anything, the deals are going to get better and better for the targets over the next 18 months because nobody wants to return money and not complete a transaction. But I think so. Look, I would argue, Ed, I think the SEC has de facto already spoken on this topic with even though it's only been some public statements in that. I think they have definitely signaled to people, as I think Andrew's foreshadowed, that something is coming here. Look, I think if the SEC, I think the main thing that the SEC should do is just lay out exactly what the disclosure regime should be. And I think if they did that, and then I think the market would react to it, and we'd figure out whether are there still active investors who want to do the SPAC transaction, with potential liability that accrues to it, and with a more plain English disclosure regime.
Beyond disclosure, are there other features that you care about? So Andrew suggests locking the sponsor up for the duration of the projections. Another possibility would be to tie the shares with the warrants, so that if you redeem the shares, you lose the warrants. These are things, of course, that SPAC sponsors could do today.
Right.
Are these things that you look for when a SPAC sponsor comes to you and says, let's do a deal? Do you say, well, let me see the terms of your SPAC?
Yeah, we do. We certainly do. Absolutely. And look, I agree that all those things should be considered. I guess I would argue, I don't think that's the role of the regulator. I think that's the role of the market. And as I said, I think when you see things like Tontine and some of these newer versions, I think the market is starting to address those issues, right? The more recent SPACs do not have as egregious of sponsor promotes or warrant structures as we saw, even 12 or 18 months ago.
Rachel?
Yeah, I mean, in fact, you saw warrantless SPACs, like right before the SEC threw the whole warrant issue and kind of delayed, I'd say, by 2 months, all of the progress there. You were seeing warrantless SPACs, which have been really interesting, right? If you're comparing as a target a SPAC that has warrants versus one that doesn't, there's an economic evaluation, but there is also the valuation, are we going to get this deal approved, right? That's going to open that analysis too. Warrants, the existence of warrants assures the approval of the deal in a way that no warrants don't. But you had already seen the market moving for a variety of different reasons to no warrants. So I am very much in line with Scott. The market needs to determine those. The lockup is market based. It's moved over time. It was started at 2 years, in Clarivate. It moved because of market dynamics, and it will move back if that is not the right thing and the market doesn't like it. I think disclosure is the right answer. It's always been the right answer. That's what that's our regime. But I do think the market's pretty efficient, and obviously sometimes moves before the SEC can. So I think by the time the SEC brings some rules around, there's probably already going to be additional disclosures. There's already, and we see in place, additional diligence happening, in presumption or in anticipation of potential liabilities for various parties. So all of those things are actually already happening. And I think it's right. This is a nascent stage of this process. It's crazy, but it's starting to balance out, and you're going to see convergence of popular ideas across IPOs, de-SPACs, and SPACs, so that they all become a little bit more similar and much more nuanced in their differences.
So just one sort of corporate law as opposed to securities question, so when the SPAC is considering a de-SPAC merger, you obviously, the board of directors of the SPAC needs to make a judgment about whether to recommend this merger to the SPAC investors. And under Delaware law, that's a focus of a great deal of fiduciary duty. And there's now a little bit of litigation around this, because the SPAC sponsor board often will be in a complex situation. They may hold warrants. They may be concerned about both warrant holders versus shareholders. In advising the SPAC sponsor board at that key stage, what's the best practice there? At this point, there's no decision more important to a board than whether to recommend a merger. And how then, given this weird is the wrong word, this complex set of interests created by the SPAC structure, how do you guide the board of the SPAC sponsor of the SPAC in that context?
That's a good question. I really only represent targets. So the answer is I hope that they're getting good advice on that. But if I were to represent them, I would say you have to take into the interest of all shareholders, right? You need to diligence this business. This is where I think is probably one of the biggest issues for boards, is how much diligence do you know about the business that you're actually recommending? So these projections that end up in the document are usually some subset of things that they've considered, but it needs to be very thorough. There needs to be a from what I've seen, the level of diligence that's done is not the same as is done in a strategic M&A transaction. It's not. It's a different level, and it moves very quickly. So I think advising the board of their liability and their fiduciary duty obligations and then emphasizing the importance of diligence, right? Because these deals will only continue to get increased scrutiny, as you've noted. We're already getting some very extensive commentary from the SEC around background sections. So typically the target will draft the bulk of the disclosure, but the background sections come from the SPAC and their counsel, and we're getting increased number of commentary on that background and really pushing what did the board think about. I mean, Scott has probably sat on these boards and probably has received this advice. So I'm curious what his thoughts are, but diligence seems very, very important to me.
Scott, we have a minute or two left. Final thoughts?
Yeah, I would agree with all that. And I think at least there's a case that is making its way through the courts right now, asserting that entire fairness effectively is now going to be the review standard. At least that's what the plaintiffs are alleging. And I agree. Look, I think, I do think you have enough, there's probably enough colorable questions about conflicts that I would imagine if I were sitting on a board today, I would tell the board, you should assume this will be reviewed under entire fairness. I think that is at least the right standard to condition people on right now.
Michael, final thoughts?
No, I'm just been a fantastic event, and it's just been so fascinating to watch this market develop, and really looking forward to see what happens next in the markets and the regulatory space and all of that.
Rachel, Scott, Michael, Andrew, thanks so much for taking the time to participate today. Thank you to the audience. The questions were great, and I managed to weave quite a few of them into the Q&A. Stay tuned. SPACs are not going anyplace right now, and I think the predictions that the SEC is going to do something are likely true. John Coates, as acting head of Corp Fin, certainly suggested that they're going to be looking closely at SPACs, and I have no doubt that the folks in the enforcement division are also going to be examining some of the crazier things that have gone on. So stay tuned, and thanks all for joining us today. And thanks to Latham & Watkins for sponsoring the Latham & Watkins Forum.
Thank you.